Some people are a bit cautious though, despite the strong performance of the market. Jitendra Shriram of HSBC Asset Management Company is one of them. Jitendra, thanks very much for joining in. What's your sense? Why are you cautious at these levels, and why are you guys underweight despite the strong pullback of the last few weeks?
Well, one of the factors is that, if you look at Indian market, overall P's, they continue to be trading at a premium to rest of Asia. Whereas if you look at ROEs vis-a-vis Asia, they have shown pretty much a converging trend over the last 7-8 years. So we are not saying that market probably has more downside from here. In a sense, as I mentioned last time also, our year-end target for Sensex is 20,700, but we see limited upside for the market from here on, and we are more constructive about other markets in Asia. It's mainly valuations. We think that a lot of this premia which India has historically seen is difficult to sustain given the convergence of the ROEs. So from that aspect, we are at the margin slightly more cautious on India than other markets in Asia.
Jitendra, morning. So has selling already begun in select sectors where you're uncomfortable with valuations, or do you think tactically that time hasn't come?
Well, clearly what we are seeing is some slowdown in flows, but I won't say that the flows are yet not there. It is still pretty much there. The flows continue to be strong, and it's obviously been a fairly powerful rally which we have seen in the last couple of weeks. I would think that you should probably see that one of the kind of dose of reality for markets will be the kind of results that come out, because up till now normally the early part of the season is associated with the better part of the results, and as you see a lot of the industrials, the metals names and so on, as they report into the closing of the results season, you might see some kind of reality check come back into markets there.
SBI reports this week as well, Jitendra, and banks have really been the bulwark of this markets rally. How are you approaching that sector?
Well, there are two ways to look at it. One is we are definitely positive on the NBFC side of the story, whether it is the PFC, REC, IDFC kind of names. One part of the thesis here is that clearly institutional borrowing rates will ease given the kind of softness that you're seeing in gilt yields, and also the kind of actions that have been done by the RBI, almost about 125 basis points of rate cuts over the past few months. So I think with probably a little bit of a lag effect, you should start seeing that impact. So funding costs should ease for the NBFC segment. That's one side that we are positive on. Selectively on private sector banks as well, we are positive. We still continue to be cautious on other state-owned banks. Although there could be some trading upside on the bond portfolio that they own, especially given the softness in yields. I suspect you'll see asset quality strain continuing to be an overhang on this sector. The other issue is clearly pension liabilities will rise given the softness in yields as well. So that is something that one needs to be worried about from a 12-month perspective.
What about politics, Jitendra? Do you think the market will start fretting about it soon, or do you think that's an event which will only come about at the fag end of this calendar or start of next calendar year?
Well, general elections, maybe, yes, it might still has time to run. But I would say that, the calendar starts heating up from November, December, when, you have 3 material states going in for elections. So I would suspect that, you have a reform window which is open probably at best till about September. So maybe up to the monsoon session of Parliament or somewhere around that. So after that, one of the key things that market will see is how much does the pendulum swing the other way from being reformist to being populist. So that is something that market will keep a keen eye out for. And my suspicion is that, probably from here till the next 2-3 months is the best we will see of reforms, because after that I suspect there will be a strong tendency to become more populist.
So what is your prognosis between now and the October-November period for the market? Do you think it holds a range, or do you expect to see a lot of volatility?
Well, I would think it will hold the range because the global liquidity situation continues to be fairly strong. So I think it would still continue to probably grind up a little. But I would think that, maybe closer to when the election commission decides on the state polling dates and so on, you could start seeing also the tendency to become slightly more populist. Also the pre-electoral spending which commences either from the state or the center would start, and that would actually start, you might start seeing some kind of easing up on the markets around that.
You also point out in your note that you believe this consensus earnings target of 15% for FY14 looks optimistic. That would have corrected, no, Jitendra? I mean, how many people are still going with 15%, and how much are you guys going with for FY14?
Yeah, we are much closer to about 9 to 10% kind of a growth, but I would think that a lot of the adjustment would probably happen as the result season gets fully underway. Up till now, as I mentioned earlier, you have the positive results which have come through. So as the state-owned banks report, the metals, industrials, the sectors which have actually seen the worst of this kind of sluggish IIP hit them, that as they start reporting, you will start seeing the earnings getting discounted. So I agree with you that probably this number is about a month old or so, but as the full year results come in, you will start seeing people make the adjustments to the full year earnings for FY13, and as a result, the base for 14 also goes down a little bit, and that would have its implications in terms of growth forecast. So I do see some degree of cuts. And let me reiterate one other thing. In the budget, you've actually seen an effective tax increase of roughly maybe about 100 basis points. If you look at the last couple of months, there's been no cut in consensus estimates as a result of what the budget had espoused. So to that extent, I would think even the analyst community would make those incremental increases in tax rates also, which will be a hit on earnings going forward.
I noticed from your note that you guys have an overweight on Titan. What have you made of this big collapse on gold, and how are you approaching stocks like Titan as also these gold NBFCs?
Okay, we don't cover the gold NBFCs, but on Titan itself, see, the basic thing that we see in the sector here is that there has been a good volume uptick. If you look at the recent data that's come out on our gold imports as well, it suggests that there is a lot of traction in terms of demand. So it seems like consumer interest, which was probably suppressed because of elevated gold prices, that's come back with a bang. Part of it could also be because of festive demand like Akshaya Tritiya, etc. But we do see that there is a lot of traction building up. Most jewelry shops at least seem to indicate that whatever were their monthly targets, they seem to have achieved it in probably 3 weeks in April. So I do think that the short run holds good promise in terms of the quarterly numbers. The second factor also is that there is clearly good growth coming in there in terms of the square footage addition and so on, which makes the case for the longer term story as well quite strong. Also, do remember the jewelry market in India is still fairly unorganized, and the organized segment is still under 10. So even though the macro story may see potentially some easing over a period of time, the fact is organized players as a proportion of the total market will continue to rise, which is again a strong bull story in favor of the organized retailers. That's what makes our case, why we continue to be overweight on this name.
Thanks, Jitendra, for joining in with your thoughts.